Hello everyone, this is Vinod Prajapati. In this video, we'll be reviewing the latest monetary policy statement released on 8th February 2023 by the Monetary Policy Committee headed by the Governor of RBI. Because our approach is focused towards personal finance, after analyzing the monetary policy statement, we'll see how it impacts our equity investments, fixed income investments, and loan EMIs. Before we analyze monetary policy, let us quickly look at the framework and instruments used in maintaining price stability while keeping in mind the objective of growth. When we deposit money in the bank, banks are required to maintain part of it as mandatory reserves with RBI. These reserve ratios are called CRR and SLR, and at present they are at 4.5% and 18% respectively. RBI, at its discretion, changes these rates from time to time. Balance, after maintaining these reserves, banks are allowed to use them for all commercial purposes. Now, assume that due to a lower demand for loans, the bank is able to utilize only 70 rupees for commercial purposes out of 77.5 rupees available. In such cases, banks can park the excess balance, that is 7.75 rupees, with RBI and earn 6.25% interest on them. Therefore,
Standing deposit facility rate
is an option for banks to park their surplus balance on an overnight basis.
in April 2022.
RBI introduced the Standing Deposit Facility SDF, an additional tool for absorbing liquidity without any collateral. The SDF rate will be 25 basis points below the policy rate, that is repo rate. It would, however, retain the flexibility to absorb liquidity for longer tenures as and when the need arises with appropriate pricing. Now assume that because of more demand for loans or due to a large withdrawal by a group of depositors, the bank had utilized 80 rupees for commercial purposes out of 77.5 rupees available. Here, the bank has overutilized the depositors' money. Therefore, the bank can borrow from RBI at repo rate by pledging their eligible securities to meet the shortfalls and replenish their mandatory reserve requirements, that is CRR and SLR. MSF, or Marginal Standing Facility Rate, is an overnight loan facility against eligible securities. Under MSF, banks can pledge overnight securities from SLR quota up to 2%. Then, even if SLR comes down below 18%, banks need not pay any penalty under MSF. Bank rate is the rate or discount at which RBI grants loan or advances to commercial bank for up to 28 days. RBI can grant loans both with and without pledging securities. And now let's look at the details of monetary policy. As the main focus area of the Monetary Policy Committee is inflation and growth, they do provide future estimates for the same. Accordingly, the real GDP growth estimate for India is revised upward to 7% from 6.8%. And inflation forecast for financial year 2023 is revised downward to 6.5% from the earlier estimate of 6.7%. The Monetary Policy Committee delivered the statement with an objective of keeping the inflation expectation anchored to global risk, breaking the persistent core inflation, and strengthening medium term growth prospects, thus keeping the focus on the withdrawal of excess liquidity to maintain inflation within the range and support economic growth. Reviewing the consensus of market participants and experts, it seems that near-term slowdown in economic growth as an effect of rate hike and moderation in inflation will pause further rate hikes. And going forward, fixed income investors will look for hints of the beginning of downward rate cycle. Coming to the economic highlights presented during the monetary policy statement, the outlook for global growth has improved along with an upward revision in India's GDP growth projection to 7% from an earlier projection of 6.8%. Looking at the positive news globally, inflation has softened and the size and pace of rate hikes have moderated. The US dollar has come off from its peak and equity market have moved higher. On the other hand, India's economic growth has remained strong with strong discretionary spending, improving rural demand, and a foreign exchange reserve of USD $576 billion. It's third month in a row that the inflation rate has been within the comfortable range of RBI. The risk to global growth remains as central banks are reiterating their commitment to bring down inflation and thus capital flows and bond yields are volatile. Though the growth outlook has improved, external demand continues to remain weak. Domestically, we are experiencing non-oil and non-gold imports expanding and contraction in merchandise export due to weak external demand. Fuel inflation edged up and also core inflation has remained elevated at a little above the RBI's comfort zone. Considering these economic factors, risk and assumptions of an average crude oil price of around $95 per barrel and a normal monsoon, the Monetary Policy Committee forecast an inflation rate of 6.5% for FY 2023, lower than the earlier forecast of 6.7%. Similarly, the Monetary Policy Committee forecast economic growth upward at 7% from the earlier forecast of 6.8%. After understanding the monetary policy statement and the outlook for inflation and economic growth, we believe that even though the rate hike cycle coming to an end, the equity market will remain range bound on account of the valuation gap from our peer emerging countries. Thus, we believe that investors should maintain a neutral equity allocation as per their risk profile and a diversification at asset level and geographically. For fixed income investors, the good thing is that inflation and interest rates seem to moderate. However, the risk from geopolitical escalation and adverse weather continues to remain. Thus, we believe a mix of short-term and medium-term bond portfolio would be ideal for investors with an investment horizon of 3 years and above. For home loan borrowers, we continue to believe that if they have liquidity, full or part payment of their loans will be an ideal solution. If they want to maintain liquidity, then shifting their home loans to an overdraft based home loan will make sense. This is just our point of view and not a recommendation. We strongly suggest you to consult with your investment advisor or do your own research before taking any action. Hope you're liking our content. Please like, share, and subscribe to our channel.